Hello and welcome, and I'm your host, Konstantin Kogan. We're here at Holistic Investments, and I'm excited to have two amazing guests today. So we're talking about arch lending. We're going to talk about like credit. We're going to talk about like different ways how you can get credited with without touching your crypto. And I'm really excited to have two amazing founders today with Dhruv Patel and Himanshu Sahay. Hi, guys.
Thanks for having us.
Thank you for being here. And as I notified you in advance, we're throwing a short legal disclaimer. So this content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or any other advice. Now that we're off the hook, we can talk a lot about what you're doing, guys. But first, I want to start a bit from a personal note, right? Tell us more. What made you leave? I know both of you were having successful traditional fintech career, and then you moved to crypto blockchain. Tell us a little bit about this transition.
Yeah, I'm happy to go first. So I'm Himanshu. I'm co-founder CTO here at Arch. And I have a background, as you mentioned, in more traditional consumer tech. Started my career at Tinder. Moved on to bird scooters early on, and then at Snapchat for a couple of years. But along the way, was investing in companies as an angel. Had a small fund for a while, and just kept seeing this lack of liquidity in what we call alternative markets. In that case, it was shares in private companies. I was also, just by nature of the cycle at the time, quite involved with crypto through me and people around me, and met Dhruv in this journey. And I'll let Dhruv continue the story from there.
Yeah, and hey, I'm Dhruv, co-founder, CEO here at Arch. And my background is more traditional fintech financial services. So I started my career off at Bridgewater Associates, was there as a quant on the research side, and then left them to join a fintech startup called Brex early on, where I spent a couple of years launching and scaling different lending products. And as Himanshu alluded to, was investing in crypto and other tech startups along the way, and really just noticed that many traditional lenders and fintech companies would largely not look at these assets when they're deciding whether or not to give someone a loan or how much, to lend out to them. And so that was the genesis behind Arch, was really to build a full stack financial services company for individuals and institutions with alternative assets. And the first asset class that we started with is crypto. And, we do crypto backed loans, which I'm sure we'll get deeper into throughout this conversation.
100%. I mean, great careers. Bridgewater, which is, just for someone who doesn't know, like one of the, probably the biggest hedge fund in the world, right? And one of the most successful one. Snapchat, Tinder, you guys one of the perfect combination in terms of the founders that investors want to see. Now, I'm also sure there are a lot of challenges, which drove you to do something that is your passion. Can you talk a little bit of what inspired you personally to start Arch Lending?
Yeah, I think for me, it was really, I saw this problem firsthand. I went to go and get a financial loan or mortgage from a bank, and they ask you, to show your portfolio. And at the time, if you show them equity in Brex or in crypto, both of which I had, they sort of looked at it and they were like, yeah, these count as zero. And so, for me, it was quite jarring and seemed very inefficient. And then I saw that similarly with a few different people around me and realized that this is just, quite a big problem when you look at the number of people impacted. And so that was really the motivation behind going down this path.
And I think conversely, if you look at in the traditional markets, if you have the assets that they support, you get so much flexibility with the kind of structures that are offered once you get to a certain net worth. There's a structure called an equity line of credit, which lets you cross-collateralize all your assets wherever they are into one line of credit. So we want to bring something of similar ease of use to these alternative markets so people can benefit from maximum capital efficiency in these markets.
Now, a lot of those, again, and forgive me for my directness, right? A lot of those words for people who are coming from retail background, who don't have fintech, traditional consumer background as you guys, it might be complicated. So let's break it down to simple terms, right? For example, you're solving a problem for people to get liquidity for someone who's already invested, right? They might have either an equity portfolio or crypto or a combination of both, right? And they don't have money to invest right now, but they have something to almost put as a collateral, right? So let's break down this problem to several levels. Who are your major customers and how do you solve their problem?
Yeah, maybe I can take the individual side if you want to take the institution. So one way to think about what we're doing is actually for the normal person akin to like a pawn shop where you put up an asset as collateral and then you get to take out a loan against it, right? That's different than having a unsecured personal loan or things of that sort. In this case, we target high net worth individuals and give them loans against their cryptocurrency, whether it's Bitcoin, Ethereum, staked Ethereum. And we also look at select companies in private startups. But really, I'll focus this conversation on the crypto side, just given your audience and I think where most people will get value here. Here, what it looks like is essentially people will post up their Bitcoin as collateral. Let's say they have $1 million of Bitcoin just for simple math. You can get a loan of up to $650,000. And what we really see people use this money for is a fewfold. One is folks make other investments with this money, whether it's buying additional crypto, getting into stocks, buying real estate. The second is to cover any large expenses that have come off, whether it's a tax bill or a healthcare bill. And then the third really is for day-to-day personal lifestyle, maybe to take a vacation or things of that sort are use cases that we've seen. But really it's leveraging the asset base that you have already to then fund any investments or expenses that come up.
Yeah, and if you don't mind, if we can dig a little bit deeper in this side, right? So as an individual, I cannot come to the bank, as you mentioned. They don't care. They don't even take it as a collateral, right? For them, it's non-existent. Now, in your case, first of all, let's define, you're talking about, for now, mostly US customers, right?
Yes, that's right.
Correct. So for now, I'm sure you're going to expand, and that's what I sincerely wish you, right? But for now, we're talking about the United States. Now, let's imagine we have already, I ballpark numbers, I remember like more than 40 million people somehow in any shape or form own digital assets, right? You mentioned that it's mostly for high net worth individuals. Now, imagine a use case, a person is almost there, but still not like a high net worth individuals according to the FINRA/SEC, norms, right? Let's say he has, I don't know, 200-300K. So would he still be able to be a customer of yours?
Yeah, that's a good clarification. So our platform and company as it stands can support loans, up like as low as $1,000 and up. The reason we say high net worth individuals is really that's the type of customers that we've seen come to our platform where the average loans that they're taking out is at least 100K or slightly more than that. But we can certainly support loans of lower sizes.
Got it. And then obviously they have to provide all the documentation, like I assume do the know your customer and provide all the proof that they have those funds, right? Now, other question, which I'm sure you get a lot after what happened with the BlockFi, the Celsius of the world, right? I think it's important to also talk about this side because retail now have a little bit lower trust of the institutions, who are providing them loans. So any risks that you can maybe remove from the myth people have?
Yeah, before I answer that, maybe it's worthwhile if Himanshu just talks about the other segment that we target company, just because it's relevant, and then we can go into the risks.
Yeah, so as we mentioned earlier, we have two business lines. One is for high net worth retail, and then the other, which is a bit more nuanced, is for institutions. So the kind of customers we have on the institutional side is anything from a crypto exchange, a token foundation, a DAO treasury, a Bitcoin miner, or anyone involved in mining infrastructure, as well as hedge funds and market makers, which have frequent borrowing needs. So in this case, we're usually looking for customers that want to maximize capital efficiency. And what that means is how can they get more money from what they have today? So it could be an exchange that has a lot of Bitcoin in their treasury, and they want to come use that as collateral to get US dollars or stablecoins to fund operational purposes. It could be a similar use case for treasuries, for foundations. We've seen foundations want to use their Ethereum that they hold in their treasury as collateral to get a loan to go invest in hedge funds or go invest in some other kind of investment fund. So there's a lot of these use cases, and ticket sizes here are typically much larger, anywhere from $1 million and up. and they can go much higher from there. And these needs are typically a lot more frequent than a retail borrower need, because these people want to keep leveraging their assets to be as capital efficient as possible.
Well, and I'm sure they have more need in that. Like, the only thing which, again, and maybe you can correct me if I'm wrong, like those clients, institutions, typically they have options, right? They have several players like you, like yourself, maybe in some shape or form, who are providing them the services, right? I think for retail, sometimes it's even more complicated, right? Because they don't have a lot of options, especially now when the trust is very low. And also, just to clarify, that's also provide them an upside. The reason why people want to keep Bitcoin or Ethereum, right? Because they don't want to sell it, right? They believe, let's say I don't know, in the coming 2 years, it will make 5x, right? Not to speculate, but that's the bottom line, right? That's why they don't want to sell it. They want to still keep it and get, US dollars to pay for their needs or any essential purchases, as you mentioned, right? So how do you restore trust after what happened with Voyager, Celsius, and many other companies? I'm curious. I'm sure you get a lot of questions like this.
Yeah, certainly. I think first it's helpful to frame, what were some of the issues that caused the downfall of those lenders and what we're doing differently to position ourselves and really gain customer trust. So two key things. One was that those other companies rehypothecated customer assets. And what that means is, quite simply, when you put assets on those platforms, they would lend it out to other institutions. And so that creates additional risk because your assets are held by some third party now. And if they go bankrupt, then your assets are also at risk. The second is both the assets that these lenders accepted, as well as the types of lending they did. So you would see lenders accept assets that are very illiquid, or while everything in crypto is listed on some exchange or decentralized exchange, it might not have the liquidity needed. And last was, not all of it was over-collateralized lending. You did see players doing one-to-one or even under-collateralized, and that can get risky, especially when there's a lot of market volatility. And so those were the three broad buckets that got other lenders in trouble. Now, when you look at what we're doing at Arch, it's essentially the opposite of all of those, where we only touch select assets that are very blue chip, highly liquid. When you look at Bitcoin, Ethereum, liquid staked Ethereum and other tokens, as well as we do only over collateralized lending, and we do not touch customer assets. Those sit at qualified custodians such as Mythical.
And that's very interesting because, again, I'm sure you have a lot of questions. What happens, and we still have an impermanent loss risk, right? So let's imagine something cataclysmic events, right? And there's global recessions first, and for whatever reason, any asset that you're taking as a collateral is going down 20% one day, which, of course, God forbid it happens. But from a risk modeling, right, I'm curious to hear more, and I'm sure some of the listeners would love to do that too, to do this due diligence, to understand better what is your risk model and how does it anticipate those events.
Yeah, we've looked at a variety of metrics on the tokens that we do support with respect to historical pricing. What does the volatility look like over various timeframes, whether it's last 30 days, last quarter, last year? What does the daily liquidity look like? How has the market cap been over time to set what we call the LTV, loan to value ratio? And to reference the situation that you just outlined, our max loan to value ratio right now is 65%, which means that even if the value of an asset dropped 20% in a single day, we would still be over collateralized in that loan. And now, secondly, the other risk management measure that we have is we have the ability to auto liquidate via APIs with our custodians and other market makers that we've onboarded with, such that if the pricing does move further and the customer, after multiple notifications and a margin call, does not decide to top up or add additional collateral, we can liquidate the collateral to make sure that we get paid back as the lender.
So let's talk about this. Oh, please.
I was just saying, you can think of this as a sliding scale where you start off okay, you get to a number where you're not okay, so you get margin call, but then you have a liquidation threshold, which if that hits, no matter what, you get auto liquidated. So obviously in real life there are risks and border situations associated, but in theory, there should be no loss as long as there's enough liquidity to liquidate the pair.
So in this case, what you're saying basically that we're like you're about like 35% of the volatility you can cover, right? Because of how much you're taking as a as a loan to value ratio, right? Somewhere around this number.
That's for the most blue chip, and then if the asset is a bit less blue chip, say it's like the 10th token on the market cap list, maybe the LTV is slightly lower for that.
Here's another question, right? So obviously you mentioned already, so in case it goes over the the loan to value ratio, then you have to liquidate. How's the notification works, right? Are you calling a person? Are you writing an email, telegram message? Like, how does it work, and how much time do you provide a person to make a decision whether to top up or to liquidate?
Yeah, all the above. So we provide notifications via SMS, email, and then at the early stages, because we do have a personal point of contact with every customer, we try to be as high touch as possible. So we'll give you different thresholds for warnings. So I'll give a simple example. Let's say the loan starts at 65% LTV. You have a margin at 75%. A warning at 75%, another warning at 80%, and then 85%, let's say, is your margin call. At 85%, you get a notification across all points of contact saying that you have 24 hours to top collateral or to get liquidated. And if you don't do that, we liquidate you at the end of 24 hours. Now, having said that, if it continues to drop in those 24 hours and gets to 90 or 95, whatever the liquidation threshold is, you do unfortunately get liquidated automatically just to make sure the loan doesn't go underwater.
Makes sense. And then you mentioned that you might take sometimes a little bit more riskier assets, right, as a portfolio, right? Not the top 10, but you can take a little bit like, below top 10. Is it correct to assume?
Yeah, I mean, we haven't taken anything that risky yet. I'll say like we've taken like the longer tail of like the top 10. So for example, we could take like Polygon or maybe something like Cardano. But on those, we will be a lot more conservative on the LTV, and you wouldn't get the 65% that you get for Bitcoin and Ethereum. Having said that, the sizes we take are also relevant. So if the size is too high compared to the daily liquidity in the token, then we wouldn't do that. So we would only allow a certain size in a certain asset that we would have a loan against compared to the daily liquidity of that asset.
Now, let me ask you a more provocative question. Would you accept something like, I don't know, Dogecoin as a collateral?
Even though it would technically pass our
It would.
we do have a qualitative assessment of collateral as well, and we choose not to accept meme coins.
Yeah, I'd say like, this all being said, essentially all of our loans are Bitcoin and Ethereum. And so we are open to accepting additional ones dependent on their liquidity and volatility. But we do see a bulk of the demand in the most blue chip assets.
Does the chain matter? Like, for example, would you accept Ethereum, let's say, wrapped in, I don't know, BNB chain?
Yeah, I think like so till date, we only accept Ethereum on main chain. We actually haven't seen any requests for it from other chains. If and when that does happen, I think we'd be open to a structure of figuring it out. But for now, we just look at it on the main chain.
Makes sense. I mean, I think on the crypto side, it's more or less clear, right? Like, so how does it operate? And I'm sure there'll be more questions, which, people were going to ask even after the interview. On the equity side, I'm sure actually the ironic part for me that I've learned that people are more savvy in crypto side, they're less savvy in the equity side. So let's talk about this part, right? So individuals like angel investors, family offices, right? They can deploy to, let's say, an early stage crypto project. To simplify it, 100K allocation in a promising project at very early stage at valuation that obviously some lead investor, a VC establishes, right? And even though we talked about it a little bit before, right, offline, that let's say the project has a second round, right? They already have 5 to 6x from the valuation that you entered, right? How would you approach this task, right? Would it still be 100K? Would that be like a different number? So let's elaborate a little bit on this side.
Yeah, I think first I can just step back and outline the types of companies that we talk about when we say we give, cash against equity in these tech startups. Typically, it's companies that have a couple $100 million of annual revenue. Their valuations are typically in the like unicorn range and most likely $10 billion and up from very well-known investors. And they're very close to IPOing. Either they filed their S1s or they're going to in the coming year or that time frame. That being said, you can think of companies like a Databricks, and a few others that are similar to that stage. In terms of how we think through the valuations here, we look at a variety of data points. One is the last primary valuation, which was done by a VC or a late stage investor. The second is what are all of the secondary trades pricing the stock price at now, just so that we can triangulate, okay, if the last VC round was done a while ago, what do people think their current valuation is? And so that helps us get an assessment of how much is the equity stake worth today. And then when we look at the LTV, we go up to 35%. So we further give a discount to the current valuation to determine the amount that we would lend out to you.
From the previous round?
From the previous round triangulated with the secondary. So, it's a blend of that data point to then give you an LTV against.
So here's the interesting part, right? So first of all, thank you for clarifying that it's mostly for later stages, so pre-IPO. So we're talking about Series D or E, depending of what type of like series we're talking about. Now that means yes, it's tens of millions of dollars in revenue, a lot of due diligence, top VCs on board. However, even in those cases, as I'm sure you've noticed, lately, it's sometimes we see up to 70% or 80% discounts on the secondary stocks that are traded from the previous round.
Yeah.
So the question is here, like, how would you simulate the price? Would that be somewhere in the middle?
No, it would be like as close to the secondary as possible. Like in many cases, it will be the secondary price.
I can give you a very simple example, right? So let's take a company like Carta, which is where you see cap tables and whole shares in companies, right? So Carta's last valuation was 7 billion. Secondaries are pricing around 2 billion. So our fair market value for Carta is close to 2 billion. And then we'd give 35% of LTV on the 2 billion worth of shares.
It's that is interesting. And what happens? So in this case, for you, it doesn't really matter if they come back to 7 billion valuation. So it's still great for the customer, right? So it doesn't. And your risk is still capped, right? So you don't have like a huge exposure to the risk.
Yeah, that's right. As with any of these asset-backed loans, if the price of the collateral goes up, it benefits the customer. For us as the lender, we do just take a more conservative view amongst how we value these assets.
Now let's talk about the duration, because again, the companies, even on later stages, they don't guarantee that they go IPO. For whatever reason, they might change their strategy, and they actually can decide not to go the IPO and stay private, right? And just to generate more cash or expand, etc. So what would be your reassessment? Let's imagine in 1 year you still hold the collateral. You come back to a person and you renegotiate, or how does it work?
Yeah, so the duration of the loan gets repaid as when the company IPOs or experiences an M&A event. And so, it's a flexible duration depending on the specific company. But to your point, the reason that late stage and pre-IPO companies are picked, it's often because the average duration that we've seen is around 3 to 5 years here.
So now I'm paying you interest on the loan still year.
You're not paying us interest as the loan is going on. It accrues, but you don't pay us anything until there's liquidity on the shares.
Got it. So that's the bottom line, right? So basically, only in 5 years, what you do, you accumulate the entire fees, right? And then when you liquidate the position, and then also, by the way, as I remember, there's a 6-month holding period even after you sell the shares. So that's when you liquidate, you take out your share, and then that means you liquidate for them, or you still have brokers who are like you're partnering with.
Yeah, the customer, liquidates as the shares are under their name at that point, and then distributes out the proceeds of the sale.
Got it. That's an interesting model. So let's talk about the crypto loan and a little bit and come back to this point, right? We haven't talked about the fees, right? So let's talk about the fee structure. As much transparent as you can be, obviously, there's no specifics, but like you can give at least a range. How much is it cost for a client to take a loan from you?
Yeah, our structure is fairly straightforward and very transparent, where the main fee is the interest rate, which is a 12% APR as it stands today. Obviously, that will change as the government raises interest rates or decreases interest rates as well. Besides that, the only other two fees we have is a late payment fee. If a customer makes their monthly payment later than it was otherwise due, as well as a 2% liquidation fee, which only comes into the effect if the loan ever reaches a state where the collateral needs to be liquidated to make the payment.
Got it. And you have flexibility to pay back earlier. Obviously, there's no.
Yeah, there's no repayment fee. Customers can repay back partially or in full anytime throughout the duration of the loan.
Got it. And then in terms of like amortization and overall duration, so let's imagine a person decides to provide to extend the loan, right? So there's a 12 month, now it goes to 24 month. Again, the terms are staying the same.
So in that case, what would be happening is a refinance of the loan. When you do 12 months, that 12 months is over, you would sign another 12 months and the terms would be at whatever the interest rate is at that point in time.
Mm-hmm. So you would basically renegotiate the rate. It might change.
Yeah. And our interest rate is simply a function of what the federal funds rate is at any given time. So, if it's lower, hopefully it is in the future, that might go down. And then if it's not, well, it'll stay the same or go up.
Yes, for sure. I think we're all hoping that the interest rates will go down eventually, but the reality says that it will go only up, unfortunately, right? What are the other things you're seeing overall in the space we're talking about like Web3 space of the products that you believe will appear soon, like with your help, or maybe you think generally overall in the market, that traditional credit and lending I would say infrastructure already provides?
Yeah, I think we touched on this a little bit earlier. So a lot of people that we support just on the individual side, and there's a lot on the institutional side we can touch on as well. But just on the individual side, a lot of these customers that we have are existing customers or would be customers of private banks, where they get access to an equity line of credit, where they just go to the banker and they say, hey UBS, here's my house, all my stocks, and my cash and a few other assets I have, give me a line of credit, and I never have to sell anything ever again because I just have the credit and I keep paying that off. Our customers, unfortunately, when they go to UBS and they tell them, hey, here's my crypto or here's my equity in deal, they're like, well, you're worth $0, and that's not okay, right? So I think what's really exciting about our future is being able to access liquidity across all the asset classes together. So when you come to Arch, you can tell us, here's my LP stake in this fund, here's my shares in Carta or Databricks or whatever, here's my crypto, and here's my equity stake in the KKR private equity fund, right? And then give me a line of credit against all of these, and let me use this to leverage into other investments across these alternative assets. I think that's a really exciting future, and that's where these asset classes get to be as relevant to the individual as they are as traditional asset classes are, because then you can really maximize what you can do with them. Like credit is one of the foundational structures of the financial world, always has been for thousands of years. And I think this is how we get to the next level with high net worth individuals in this new asset class that we have today.
Yeah, and I think aside from just lending, other things that individuals can sort of like expect from Arch and that we have done our pipeline are allowing folks to make investments through us, whether it's buying treasuries or other bond type investments, accessing like private equity funds, hedge funds, things of that sort, so that Arch becomes a full stack financial platform for individuals where not only can they do lending, they can have deposits with us, they can make investments and really do everything they need to in one platform.
And I think on the institutional side as well, as lending gets more and more current, and as we get back to maybe a safer but better form of lending for institutions, which isn't fully uncollateralized, I think there's a lot of opportunity in providing more bespoke structures to people like miners, right? Like they have daily liquidity, being able to offer loans against that. There's loans in trading accounts for hedge funds, which are always looking to borrow more to increase capital efficiency. There's a number of on-chain trading platforms now that hedge funds use that are prime places for us to lend into, and other companies like us, which have no liquidity today in terms of lending. So there's a huge opportunity, and I think as trading volumes come back and the demand for liquidity is just higher and higher, there's going to be much more innovation and increased usage of all these products.
You actually like that was a very kind of very loaded answer, right? So that's why I want to like break it down to the several questions. Which is, I love your vision, guys. Like now, do you foresee that in the future, let's say at Arch, even like in our lending, you will have an opportunity that an individual would have a position in a liquid hedge fund? He would have a position in a staking platform, and you will be able to use those two products to simplify it even as a collateral for the loan as well.
Yeah, you can already do one of those. So if you have any liquid stake positions, especially blue chip ones like Lido, Wrap/ETH, you can already get a loan against us from that. CB, Lido, Wrap/ETH, Lido, Wrap/ETH, Rocket ETH, etc. You can already use. LP stakes in hedge funds, as long as they're liquid, would be absolutely relevant and something we can support. Obviously, there's some question of due diligence on hedge funds, and there's a lot of exciting projects now that provide on-chain diligence that can be shared in an anonymous manner. So once we are able to access things like that, I think being able to offer liquidity against those things is very exciting and something we'd like to be able to do.
Now, you mentioned something, my second question, actually, very naturally, progression of the previous one, right? You mentioned more reputable, so to speak, right? Platforms, right? And that's verifiable, audited, etc., right? Like Lido and then many others. Now, what happens if I have a big position in less reputable platform, right? But my position there is like probably 10 times bigger than any other platform, right? And you, all of a sudden, you don't recognize it. So what's the best course of action, especially when my, whatever, like ETH is locked for a year?
Yeah, I think, you know, this goes in the spectrum of assets, right? Like as you have riskier assets, it's harder to get debt against it. So even in a scenario of like what you're talking about, let's say you have equity in a pre-seed company, it's very tough to find anybody to give you a loan against that. Or if it's, you know, a very alternative crypto token that has $10,000 of liquidity, it's tough. And so I think in some of those situations, the best case a user has is either they sell or you sort of hold if you really believe in the project until it hits a more mature stage where lenders can sort of allow that as collateral. That being said, you know, we're always interested in seeing if there's sort of unique and innovative ways that we can accept certain tokens in a very risk appropriate manner. But that would be roughly how I would think about it.
You know, our vision really here is to build something long-term that's risk adjusted and that is going to be around through multiple bull and bear cycles. A very simple example from last year where this exact thing happened was Alameda using FTT tokens with very low liquidity as collateral for a BlockFi loan. And then obviously there was no liquidity in being able to liquidate them. So we would not like to be in a situation like that.
And that's very smart, and I'm happy that you're very cautious about it after what happened. But still, do you foresee that maybe there would be like another player in the industry, in the credit and like crypto industry, who will be able to absorb this risk? Let's imagine someone comes to you like, you know, with more appetite to risk, and they actually accept it as a collateral, and they underwrite this position, and they will be in front of you as people who would like later they take higher, whatever, like the LTV may be even as crazy as like the vice versa, right? 35 to 65, right? And then it will come to you with other position of ETH, and they will become your client.
Yeah, and perhaps I think there could be a world, for example, like you already see there could be like NFT lenders that accept NFTs. We don't accept that as collateral, and other assets as well. So I think it's reasonable to assume there could be other lenders that accept more riskier assets that we don't currently accept. And yeah.
But by the way, talking about NFT, that was my other question, right? So obviously a lot of NFTs are like 95% probably of them are not like holding the value, but something like CryptoPunks, like it's even impossible to buy. So there's a very like, you know, the actual like, you know, value of this, right, you know, is pretty high. So even the top one you would still not accept?
So in the NFT lending world, there's a few issues. One, I'll maybe like set the stage. There's like peer-to-peer, which is like Archaea, etc., and there's peer-to-pool, which is like Blur, right, where you can liquidate through a pool. So in peer-to-peer, like getting liquidation is hard. Peer-to-pool, at least there's an option if you want to liquidate, and someone will, in theory, buy it in the auction, right? The problem is all the liquidity in these, even in the top collections, sits at the floor. So if your CryptoPunk is a very high value one, it doesn't matter. We probably still, unfortunately, have to value it at the floor and slightly lower to give some buffer. And then it's very hard to guarantee liquidity against these things. Our position of the company isn't to take a directional view into any one asset for any amount of time. So we don't want to be holding an asset on our balance sheet for any time. As soon as there is a point where the loan needs to be liquidated, we have to go and get liquidity from whichever source we can, the quickest we can. Speed is definitely of importance here. So I don't think there's a world right now in which we start doing NFT lending. There's other people out there who understand how to do it better than we do, and I think that's fine. Our focus is on more asset classes, that our customers are a bit more interested in. I think that's more of the more traditional alternatives, such as the ones that we mentioned earlier, like crypto, private shares, private equity, etc.
Now, let's talk about a little bit more about your best practices. Maybe you can talk about insurance. Are you using one? Are you foreseeing that more insurance players will help you to be even more protected?
Yeah, in terms of insurance, we use qualified custodians in cold custody, and so they naturally have an insurance policy for those assets. And we're in process of getting further, more pointed insurance solutions for our customers as well.
Perfect. So that means, just for anyone who's listening, qualified custodians, they're FDIC insured, right? You know, that means what we have 250K.
So qualified custodians means these are like US based trusts that are bankruptcy remote from the underlying custodian parent company. So the assets, should anything happen to the parent company of the custodian, are held and segregated in vehicles that will make sure that customers are able to get their funds back. And then they have insurance policies from the likes of Lloyd's to ensure that, you know, there is coverage if there's any sort of mismanagement with the keys or any situation where the crypto held there has been sort of misused or is lost in any way.
Yeah, and they're reporting to, you know, federal agencies, and they're like highly protected from this side, right? But in terms of FDIC insurance, do you foresee that we'll have a product that will actually almost like a guarantee you if something happens, like even the company goes bankrupt, like, you know, and for whatever reason, for a Black Swan event, one of the employees started to even enter those segregated accounts. Again, I'm talking about like worst case scenario. Do you foresee that somehow government agencies will be involved in this?
So in terms of like the FDIC piece, I'm not sure if we'll have an FDIC specifically for crypto. The same reason like we don't have that for stocks or like in your brokerage account either. That's like SPIC, it's different. Perhaps we move to that type of model and there is something similar. What we're doing at Arch and what we're planning on doing is essentially talking to these insurance brokers ourselves and getting pointed solutions for exactly what you mentioned, you know, like making sure our customer assets are safe, and whether it's like misuse or loss from our partners, you know, or any other situation.
And speaking to your point about regulation, I think at least in the US, because we are a US based and US servicing company at the moment, I think there's a long way to go for crypto regulation. So I don't suspect that an FDIC style insurance for deposits is coming anytime soon until we at least have a federally recognized, normalized crypto law.
Yeah, that would be too much of a risk. I just had this question, so I had to direct it to you guys. So I prepared some questions from some of the people who are interested in such products. And my question is more also now we're now transitioning to another component which is very important: accounting and tax perspectives, right? So let's talk about a little bit, like, how does it look, let's say, for a US citizen, a taxpayer, right, when he has a loan with you, right? And especially when the loan isn't, hasn't come to fruition and it's not like finished.
Yeah, so I mean, first I'll preference with, like, we're not tax advisors, and so I would not index solely off of anything that we say here. But a loan is not a taxable event. That's actually the reason people do borrow against these assets as opposed to sell them. And so throughout the duration of a loan, you do not pay taxes on any capital gains or any appreciation or depreciation of the asset that you borrowed against.
Yeah. So in other words, it's one of those smart strategies that, the top like tech moguls are using, like, Elon Musk. He doesn't own anything, and he actually lends money against his position in Tesla or his position in other companies, right? And then he's not paying taxes until he actually, liquidates, like, on a different level. So I think that's another, I would say, potential perk. Again, not an advice, but like another tool that you can use. I mean, and
I'd like to give you a funny example here. We have a customer who had a pretty high tax bill because of a bunch of trading activity he had last year. He didn't want to pay the bill with assets that he had. He would have to sell them, have another bill for next year because he had a pretty low cost price on these assets, which was like mostly ETH. So he proceeded to get a loan from us against that ETH to pay off his existing tax bill. And then his cost next year is just the interest rate paid to us.
Yeah, and I think that's a very smart management,
And ETH went up significantly since then, so he's happy.
Exactly. So that's, I mean, and vice versa, right? If you wanna take a loss for whatever reason, of how you optimize your own taxes, right? That's also an option, right? So you just close it, like you paid earlier, and then, like, you just declare whatever you have, and that's also potentially, if the price goes down of Ethereum or Bitcoin, right, that you can also take a loss, right?
Yeah, like, again, not tax expert, but if you wanted to take the loss here, what you would likely do is pay off the loan and then take your assets back and sell them. And at that point, once you sell it, you've locked in a loss that you can use for your tax purposes.
Correct. Yeah. So from the moment you got into contract with them, right? So there's this difference.
Yeah, exactly. Like the taxable events happen when you sell your assets, and the loan is separate from selling, right? So I would say, like, they're two similar but like different sort of streams of events that happen. Yeah.
Now, what do you think is missing overall in the current, ecosystem, right? We've talked about, like, your vision about what products will appear more, but, like, what maybe do you see the other, like, either regulators or some other players have to, like, step up to help the ecosystem grow? Because right now it seems like it's still very early.
Yeah, I think there still does need to be a lot of regulatory clarity on certain respects, and you often see it in the large institutions like Coinbase, where if you try to log on as a consumer, staking assets is allowed one day, and then later it's removed based on certain states, and it's always unclear, like, what's going on. And so I think for just the industry to sort of move forward, as well as for it to be more accessible to consumers, there needs to be advancement with respect to just how regulation looks at all of these, and making sure it's simple for companies to implement and be compliant, but also for individuals to understand what they have access to and what not.
And I think, like, there's also an elephant in the room where we are actively talking about, besides the futures, Bitcoin futures, Ethereum futures, we're talking about spot ETFs, right? So My personal belief, sooner or later, is going to be approved, right? So let's speculate a little bit, like, we don't know exactly when, but let's imagine it will be approved, at some point, maybe next year, right? How will it impact your business line?
Yeah, I think like one way to look at this is with spot ETFs being approved, what you would expect to see is a lot of money flows go into these ETFs, right? You have the big asset managers that have trillions of dollars. And so even if a small portion works its way there, all of it flows into, let's say Bitcoin, if we're talking about the Bitcoin ETF. And Bitcoin's current market cap is just a fraction of what the capital incoming flows would be. And so you'd expect the price to go up. And when there are like high upward pricing movements, or when people expect a lot of upwards movements, what you tend to see is borrowing against it, because you expect, okay, that this asset's going to go up. If I need liquidity, I don't want to sell it. Let me just borrow against it. And so we would expect to see a sort of increase in borrowing demand as there's more consolidation in the ETFs getting approved.
And I think it also speaks very well to the long-term viability of a lot of these assets, because if a pension fund or a 401k from a lot of people is investing in these, they're typically holding for a very long time. And it's just going to speak very well for Bitcoin and ETH to have more stable pricing in the future.
And by the way, a question to you as a CTO, as a person who's like working a lot with product, right? What do you see that, like, the cross-chain solutions, like, or the other user experience will also have to be like improved to match kind of a little bit more like Web2 products? Like, even though I hate this comparison, but like, it's sometimes we have to be honest, and it's more seamless. So what do you foresee that is like going to change here?
Yeah, I mean, I think design is like UX and design is something that's very important in crypto. I think one of the use cases for an ETF is that the average individual isn't able to use a crypto native product, but now they can get exposure from their brokerage like Schwab or from Robin or somewhere else, right? I think the wallet experience has to be improved drastically. We have certain like wallets everybody uses to, like MetaMask on the multi-sig sites and things like Gnosis, but it's really complicated to do anything beyond just simple transfer of tokens or a trade there. So I think the experience has to be improved a lot on the user management, on the transfer of funds, on anything that like has to be done with moving money around. Is not the simplest. People still lose money all the time by sending on the wrong chain, or by having an address that it's sending to, maybe it's off by one character and you couldn't verify whether it was correct. So a lot has to change, I think, for that to be a better experience. We've seen a number of new attempts at wallets. I think the first generation of wallets are very simple, like MetaMask, have been done, and now they're improving and adding a lot more tools like portfolio management, multi-sig, address verification, etc. And I think there's going to be a lot more in that direction coming in the future.
And then how many steps does it take to actually get approved for the loan?
For us, literally start to finish, it takes about 4 to 5 minutes. Let's walk you through it, right? You come on the website, sign up. The first screen is, what loan do you want? Let's say I want Bitcoin. Let's say for simple numbers, I want 100K loan. You choose that. The collateral number is set. You choose your state, your duration. That's all one screen. Click next. You confirm the terms you selected. Click next. You choose the wallet you want to have your money dispersed into. That's either a simple connection you can make, or you can paste an address from like your exchange wallet, like from Coinbase. Or if you want a bank account, you just choose that, like I want it in my Chase account, right? Next is KYC. Takes about 2 minutes in persona. You can do it on your phone, you can do it on the computer. That's it. You see your loan documents. After that, you hit confirm, and the money is on its way to you.
And also, one of the benefits, if I remember correctly, that there's also no credit check, which does not impact your credit score, correct?
Exactly, because this is an asset-backed loan, there is no credit check that's required, because we have more of your asset in an over-collateralized manner. That is the security we need, so we don't need to do a credit check on you.
Perfect. I think for the starter, right, it's a good approach, right? And I really sincerely wish that, you know, there'll be more products like that, seamless. Are you working on an app, on a mobile app by any chance?
We will be coming down the pipeline. I think as we launch Archpad Pulse and some of the more features that you use frequently, like with lending, you only need to check your loan status every few days or so. But with Archpad Pulse, where you have access to a lot more tools, where you can actually trade through us, you can hold deposits, and you can invest in other asset classes, there will be more of a need for a mobile app. And you know, our team has done that multiple times, and have tens of millions of people using the products that we built. So I'm not worried about launching that when the time does come. I would say sometime next year.
Perfect. Any other important integrations, I don't know, news that you want to share?
I think like we've shared the products that we have right now as well as the ones coming down the pipeline. But I'm happy to reiterate, like we have Arch Private Wealth, which is our high net worth sort of offering, where we have crypto-backed loans and loans against equity and pre-IPO startups. And then coming down the pipeline, there are investment products, deposit products, and just access to more and more high-touch, tailored financial services. And then we have the institutional side of the business, where our target customers are crypto hedge funds, miners, DAOs, treasuries, foundations. And there we're focused on over-collateralized lending as well as more bespoke lending solutions to these institutions.
And like one of the things, like, you know, just to wrap up our interview, I wanna give you a chance to share something more personal, right? We talked about business, right, which is very important, and I'm sure it's gonna grow. You guys seem so very knowledgeable in what you're presenting, but I want to hear also the personal side of you. I specifically don't notify people when I'm asking this question because I want it to come from the heart. So the question is the following: what is the meaning of life for you guys, for each individually?
What is the meaning of life? That is a deep question. I think for me, it's all about the relationships I have and the impact I'm having. And so, you know, how that manifests itself is working on problems I find interesting that I think, you know, are making a difference in the world, and the people that I'm doing it with, and the people that I have around me.
And for me, the meaning of life is an extension of the purpose of life, and I think that's different for everybody. So for me, it's fulfilling my purpose. My purpose is bringing people together. Everything I do in some way, shape, or form is in service of that purpose. So my meaning is fulfilling my purpose of bringing people together everywhere which I can.
Beautiful, guys.
Constantine, so what's yours?
That's a tricky question.
This can't be one-sided here, you know.
I've already shared it in one of the interviews, so I don't wanna read it. It didn't. I will tell you this: it didn't change, right? It's.
I'll have to link it to us offline then.
Yeah.
Yes, I will gladly tell you. The good part, we're both we're all in New York, so we're definitely gonna meet here at some point of time, and yeah, I'll gladly share with you, you know, during the cup of tea.
Certainly.
Thank you so much, guys. I think it was amazing. It's good that you shared, I would say, rather complex subjects of, you know, like crediting and you know, all the nuances, right? And I'm sure both the retail side and the institutional side will be happy to work with you. I know you're still beginning, right, where you are, and you're already successful. So I'm wishing you sincerely to grow 10x at least, you know, in the coming year. Why not? And then to show all the best practices that we discussed today.
No, I appreciate that.
Yeah, thank you. I was just gonna say, if anybody has any questions, anything they want to ask us about, I know we mentioned, as you said, like some rather complicated things. So we're happy to get on a call, talk to anybody, explain things. I think our purpose, as much as it is to find customers, is also just to educate people, because this is a new and nascent industry. So you can find us online at archlending.com. We're also on Twitter and LinkedIn. You can also email Dhruv or me directly. It's just our first name at Arch Lending, and we're happy to answer questions. We also have a beautiful office in New York, so if you want to drop by, come have a cup of coffee, talk to us here, play a game of ping pong, we're always down to do that.
Ping pong it is for sure. Perfect. So yes, you can, we're definitely going to share the, the archlending.com, like, the website, your Twitter handles, and, the guys are certainly answering pretty fast. That's how we initially connected, through the mutual friends of, as investors, and then eventually I just wanted to educate more people that such services exist, because I kid you not, like, it's actually not evident. There's a lot of people who are searching for the exactly same product that you are offering, because I went through the similar problem, but they don't know that they exist, especially after what happened with the Voyagers of the world and other companies we mentioned. Unfortunately, they are not even like trying to search. So I'm really glad that more institutional grade, secure, sound businesses like yours are appearing, and, like, again, sincerely wish you success.
Thank you so much.
Awesome. Thanks, Konstantin.